Financial reporting quality. Example 1, quality of financial reports. Now we need to understand that there are two types of quality. One is earning quality and the other one is reporting quality. Earning quality depends on the sustainability of the earnings. Let's see what this example holds for us. So Packard & Company designs, manufactures and distributes truck and related aftermarket parts that are sold worldwide under the Kenworth, Peterbilt and DAF nameplates. In 2013, the US SEC charged Packard for various accounting deficiency that clouded their financial reporting to investors in the midst of the financial crisis. The SEC complaint cites the company 2009 segment reporting, Exhibit 4A, that we're going to see in a few seconds, presents an excerpt from the notes to Packard financial statement, and Exhibit 4B presents an excerpt from management discussion and analysis of Packard's annual report. Now over here we have this excerpt from the notes, and there's very important information over here, and the information is that Packard operates in two principal segments, truck and financial services. Now the truck segment includes the manufacture of trucks and the distribution of related aftermarket parts. So there are two basic business which comes under truck segment, both of which are sold through a network of independent dealers. Now if you look at the business segment data, so income before taxes, now this over here, this truck actually also includes aftermarket parts, and the income before tax in 2009 is 25.9, and now this basically is inclusive of aftermarket parts. Now Exhibit 4B, net sales and revenues and gross margins for truck units and aftermarket parts are provided below. Now the sales and gross margin have been again divided between trucks and aftermarket parts, but in our previous scenario, the business segment 1, the income before tax were inclusive of aftermarket parts. Now let's read the question. Based on the segment data excerpt from the notes to the financial statement, was Parker's truck segment profitable in 2009? And yes, indeed we can say that the truck segment was profitable because income before taxes were positive 25.9. Now based on the data about the truck's gross margin presented in the management discussion and analysis, was Packard truck segment profitable? Now if you look over here, the net sales and revenue, if you look at the truck segment, we see that the gross margin of the truck segment alone is negative. That if we include aftermarket parts, it becomes positive. Now it is actually not profitable. The segment data presented in management discussion analysis indicates that the truck segment has had a negative gross margin. Now again we see there's a discrepancy, that one part is indicating that truck segment was profitable, but the other part indicates that the truck segment was not profitable. And the reason why it was not profitable was because the aftermarket segment was inclusive initially when we were talking about earning before taxes. Now what is the main difference between the note presentation and the management discussion and analysis presentation? So the main difference between the notes presentation and the management discussion and analysis presentation is that the aftermarket parts business is combined with the truck business in the notes but separated in management discussion and analysis. And again it's also prudent that we cannot compare these two data, because one is showing earning before interest and tax, earning before income taxes, and the other one is gross margin. Although the data are not exactly comparable in the two disclosure, because the note shows income before taxes and management discussion analysis shows gross profit, but still the two disclosures presents a different picture of Packard's profits from truck sales. Part 4. The SEC complaint stated that Packard failed to report the operating results of its aftermarket part business separately from its truck sales business as required under segment reporting requirements, which are in place to ensure that investors gain the same insight into company as it its executive. Is the PECA situation example of issues with financial reporting quality, earning quality, or both? Now, the issue is again both. There's poor reporting quality and again there's poor earning quality. The PECA situation appears to be an example of issues with both financial reporting quality and earning quality. The substantial decrease in truck sales and negative gross margin reflects poor earning quality because again this will not be sustainable, and the failure to disclose clear segment information is an instance of poor financial reporting quality. So again we are dealing with earning quality and reporting quality. Both over here are poor because they were unable to divide the truck segment and the aftermarket segment. Example 2, Convatec Group, a global medical products manufacturer, raised 1.8 billion via an IPO on the London Stock Exchange in 2016. The company had been purchased by a private equity firm from Bristol in 2008 for 4.1 billion. Exhibit 7 presents excerpt from the company's regulatory filing at the London Stock Exchange announcing its full year 2016 result. And now this is the excerpt. At constant currency, revenue grew 4% to 1.68 billion and adjusted EBITDA was 508 million, up 6.5% at constant currency. Now this is the information that is provided to us, and the headline says that it's a strong result delivering on strategies. Strong results delivering on strategy. Now we need to think whether was what they're claiming that the result was strong, was it strong enough? That's the question that we need to answer. And again in the footnotes they say that constant currency growth, what they're talking about over here, is actually calculated by restating 2016 result using 2015 foreign exchange rates for the relevant period. So we are using 2015 exchange rate as for the reporting. Now example 2 continued. So consolidated statement of profit and loss for the year ended December 2016. Now over here we see that there is a loss in 2016 and as well there is a loss in 2015. Now this information now deals with non-IFRS financial information. This release contains certain financial measures that are not defined or recognized under IFRS. These measures are referred to as adjusted measures. These measures are not measurement of financial performance or liquidity under IFRS and should not replace measures of liquidity or operating profit that are derived in accordance with IFRS. Now what is happening that we are taking revenue and we are trying to adjust the revenue. We are taking operating profit and we are trying to adjust operating profit. So revenues cannot be adjusted. So again the revenue number remains same. But operating profit indeed was adjusted and certain elements were added. These are the expenses that were added in order to get the adjusted operating profit. Now from A to G we have these expenses that were added in order to find adjusted operating profit. And now this is non-IFRS financial reporting. And if we adjust our operating profit, we actually get a net profit of 178.8. We also find adjusted EBITDA that we add software and research and development amortization, depreciation and post-IPO share-based compensation to EBIT, and we come up with EBITDA that is 507.6. Now the first question, based on the information provided, explain the difference between following two disclosures contained in Convatec press release. Now the first disclosure is the CEO review of 2016 result. At the beginning of the release states that revenue grew by 4% to 1.68 billion. Now let's check whether this claim is true or not. So the revenue went from 1650.4 to 1688.3. So let's find out the growth. Now the growth rate is 2.3%, that is not equal to 4%. So this claim is actually incorrect. Convatec consolidated statement of profit or loss shows 2016 revenue of 1.683 million and 2015 revenue of 1650.4 million. Now this is actually correct. Now let's read the answer. The amount of revenue reported on the company's income statement conforms to IFRS. Using the amounts from the income statement, the company total revenue increased by 2.3% that we calculated. Now the revenue growth of 4% in the CEO review is non-IFRS measure and calculated on a constant currency basis, which the footnote described as comparing using 2016 revenue restated at 2015 foreign exchange rates. Part B, based on the information provided, explain the difference between the following two disclosure contained in Convatec's earning release. The CEO review 2016 result states that adjusted EBITDA was 508 million, up 6.5% at constant currency. Again, this is non-IFRS that we came up with adjusted operating profit, and from that we came up with adjusted EBITDA. That is not, and we actually added expenses that are not allowed in IFRS. Part B, disclosure B, Convatec consolidated statement of profit and loss shows 2016 net loss of 202.8 million and in 2015 net loss of 93.4 million. This is actually a correct disclosure. Now let's read the answer. The amount reported on the company's income statement conforms to IFRS. Using amounts from the income statement, the company reported a loss of 202.8 million, which was more than twice as large a loss as the 93.5 million loss reported in 2015. This is actually according to IFRS. And operating profit of 154 million declined of 33.2% from the 230.4 million operating profit reported in 2016. Operating profit also declined from 230.4 to 154 million. In contrast, the adjusted EBITDA amount highlighted in the CEO review is neither defined nor recognized under IFRS. It is non-IFRS measure. To create the adjusted EBITDA, the company first begins with EBIT of 154 million and creates adjusted EBIT by adding back 8 different expenses that IFRS requires the company to recognize. This is what we were talking about initially, that we are coming up with adjusted EBIT that and adding expenses that are not allowed in IFRS, and IFRS require them to be recognized. These adjustments are listed beneath the first tabular reconciliation in items A through G. Now, after coming up with EBIT, we came up with EBITDA, and that is 2 adjusted EBITDA. Now, overall, there are 3 key differences between disclosure A and B. The first, most importantly, disclosure A refers to a non-IFRS metric rather than an IFRS compliant metric. Disclosure A refers to operating profit, which was positive because of adjusted operating profit, rather than to net income, which was negative. And disclosure A highlights a positive economic outcome, that is an increase in currency adjusted basis, that we were using this constant currency growth. And analysts should be aware of the alternative means by which earnings announcement can paint a positive picture of company's result. Now again, initially the headline said that there were strong results delivering on strategy, but when we look deeper, we actually, according to IFRS, we were incurring losses. Example 3, spectrum for assessing quality of financial reports. Jack Lake, a financial analyst, has identified several items in the financial reports of several hypothetical companies. Describe each of these items in the context of financial reporting quality spectrum. So first we have earning quality, and then we have reporting quality. Now ABC company's 2018 earnings total 233 million, including 100 million gain from selling one of its less profitable division. Now if we include 100 million in our earnings, then it's not sustainable. So the earning quality would be poor. ABC earnings for the prior 3 years total 120, 107 and 111 million, and this is consistent. If we exclude 100 million, we would be left with 133 million, and that is consistent with the continuing business. The company financial reports are extremely clear and detailed, and the company's earning announcement highlights the one-time nature of 100 million gain. Now the reporting quality is quite high because it highlights the one-time nature of 100 million gain, and reports are extremely clear and detailed. Now ABC 2018 total earning quality can be viewed as low because half of the earnings are derived from non-sustainable activity, namely the sale of the division. ABC's 2018 quality of earnings from continuing operations may be high because of the amounts are fairly consistent from year to year. So 120, 107, 111, 133, they are quite consistent from continuing operations. But still, analysts would undertake further analysis to confirm earning quality. And secondly, in general, a user of financial reports should look beyond the bottom line net income. The description provided suggests that the company reporting quality is high, the reports are clear and detailed, and the one-time nature of 100 million gain is highlighted. So earning quality, if we include 233, then it would be poor, but the reporting quality is high. Again, earning quality, we need to check whether the earnings are sustainable or not. Example 2, DFF company discloses that in 2018 it changed the depreciable life of its equipment from 3 to 15 years. Now if we increase the life, depreciation expense would go down, that will going to increase profitability. Now whether if we increase profitability because of reduced depreciation, is this sustainable? That's what we need to check. Now, equipment represents a sustainable component of the company's asset. The company's disclosure indicates that the change in permissible under the accounting standard of its jurisdiction, but provide only limited explanation of the change. Now, what it's saying about the reporting quality? So they only provide limited explanation, so the reported quality is low. And again, they are reducing their depreciation just to increase their profits, again indicating low earning quality. DFF's accounting choice appears to be within permissible accounting standard still, but its effects is to substantially lower depreciation expense and thus to increase earning for the year. The quality of reported earning is questionable. Although the new level of earnings may be sustainable, similar increase in earnings for future period might not be achievable because increasing earnings solely by changing accounting estimate is likely not sustainable. Now, because the reduction of depreciation just in order to increase profit, these kind of activities are not sustainable, so that's the reason why earning quality is poor. And secondly, the description provided suggests that the company's reporting quality is also poor because it offers only limited explanation for the change. Part 3, GHI company research and development expenditure for the past year have been approximately 3% of sales. In 2018, the company significantly reduced its research and development expenditure. Without the reduction in research and development expenditure, the company would have reported a loss, and no explanation is disclosed. Now let's talk about earning quality and reporting quality. Earning quality is definitely poor. Why? Because they are reducing research and development just because if they don't do that, they will going to report a loss. And again, it is not sustainable. And again, there is no explanation given, that again brings reporting quality down as well. Let's read the answer. GHI's operational choice to reduce its R&D may reflect real earnings management because the change enabled the company to avoid reporting a loss. In addition, the description provided suggests that the company's reporting quality is low because it does not offer an explanation for the change.